If we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
Okay, that was Jerome Powell, the Federal Reserve Chairman, the man in charge of setting interest rates in the States. And in plain English, what he is really saying is that the Fed will not stop hiking interest rates even if it leads to a recession. As simple as that. And if you look back in history, every time the Fed hiked interest rates, we had a recession within 3 years. And a more deep dive research showed that the stock market generally corrects about 6 months before a recession hits. The Fed just hiked interest rate this month by 25 basis points or 0.25%, and they will carry on hiking and take it all the way to 2.8%, which is their target interest rate. Powell also hinted that it could be even higher than the 2.8%. So now we have a timeline to work with. Let's get started. First question, are we likely to have a recession soon? Yes, there is a wide market consensus that a recession will likely happen by 2023 or early 2024. Technically, a recession is defined as a fall in GDP for 2 consecutive quarters. And just before it declines, what you typically see is an extremely strong economic growth, which simply cannot carry on because inflation also keeps getting higher. Look around you. We have inflation rate highest in 30 or even 40 years. We also have an economy which bounced back really strongly from the pandemic, and it is still growing. So we can tick these boxes of high growth rate and high inflation. So we now have some cooling down to do, and that comes from the central banks. Hiking interest rates sort of works like a brake. So going forward, we're likely to see the economy will slow. And it is only normal, right? But this time, why the stock market is especially worried about is just the timing of it. The market is already in a very vulnerable position even before the Fed started to hike interest rates. And that's all to do with the nature of the pandemic, high inflation, and the geopolitical conflict. And so the policymakers have an extremely tough job to do. Will they be able to hike interest rates without causing a recession or a market crash? To answer this properly, all we have to do is see where their priorities lie. And it is not the stock market. The main task of the central bank when the hike rate is to manage inflation. And we have just heard that they won't even care if it leads to a recession or even a market crash. Having said that, the reason why Jerome Powell and other policymakers sound relatively confident in their ability to hike rates without causing a major disaster is because they think that the economy is in a really good position. And they're right. Both the household and the corporate sector or businesses actually are already in a really good position to absorb higher interest rates. And that's because over the last many years, they have slowly been deleveraging their portfolio. In other words, they have been reducing the amount of debt that they hold in a household or in a business. And not just that, even the business level profit are at a multi-decade high because they have done so well over the pandemic. And the households, they have also managed to save in aggregate quite a bit of money by not having to spend over the pandemic years. What this means is that the high level of interest rate won't have a material impact on the interest-bearing cost of the economy. But what does the market actually think? Can the Fed or the Bank of England do it? One way to know is by looking at the yield curve. One of the signs of upcoming recession is the inversion of the yield curve. Let's go through what that means. At normal times, the yield curve is shaped like this. This shows you how much yield or return you can expect to get back by buying a government bond with borrowing period of 1, 5, all the way to 30 years. This is known as years to maturity. Bonds with high year to maturity is expected to give a higher yield because you're allocating money for a longer period of time. This is called the term premium. But this yield curve can invert. That's when low maturity bonds give high level of yields compared to the longer maturity bonds. And the main way to calculate this inversion is to take away the 2-year yield away from the 10-year yield. If the number is negative, it means we have an inverted yield curve and we may get a recession soon. And one of the ways this may happen is when the Fed hikes rates way too fast and way too much, which generally gets reflected on the shorter end, or say the 2-year number on the yield curve. That's because the federal fund interest rate is an overnight number, so a very short maturity. At the longer end, however, the yields don't move. And that happens because the market is not convinced that interest rates could stay high in the future. In other words, the market is already thinking that over the next couple of years, we will likely have a recession when the Fed will again have to cut interest rates. Now, let's look at how this signal actually worked over time in history. Did it manage to predict a recession? As you can see, this measure can give false signal, but it did work every time since the early 70s. So we have the dot-com bubble, the GFC, and even the pandemic. And as of now, you can clearly see that we are heading very close to zero. While analyzing past data, what I have noticed is that the curve usually always inverts by the time the Federal Reserve completely finishes hiking its interest rate. And what's pretty unfortunate right now is that even before the Fed started to hike rates, the curve is already really flat or very close to inversion. So this tells me that the market is not very confident about the future. But why is that? It could be due to various reasons, but one of the key reasons is that the market is maybe thinking that the Fed cannot do it. They cannot end up hiking rates without causing a recession. And there are several reasons to believe that. One of the main reasons is that our economy already started to slow down even before the Fed started to hike rates. But how do we know that? How can we actually see where the economy is going and whether it's actually slowing? Let me introduce to you something called the leading economic indicator. They help us to see whether the economy is expected to slow in the near future. There are various versions of this indicator created by various institutes, but what they typically hold are information from forward-looking surveys such as the Purchasing Manager Index and Consumer Sentiment. Together, these leading indicators can help us see turning points in a business cycle before it happens. And as you can see, the leading economic indicator from the OECD is showing us that we are entering an economic slowdown. Having said that, one of the things that no one knows about is how long this slowdown can go on for. It can go on for months or even years. And we already know that the household and the corporate sector is in a pretty good shape to absorb this higher level of interest rate. So why is the market still worried about a recession? Simple. Inflation. Think about it. Even if we saved up a lot of money during pandemic, high level of inflation basically reduces the purchasing power of that money. So we may have saved, say, £10,000 and that could buy you XYZ right now. But if you wait until next year, it may not even get you that Z because the power of that money is no longer as valuable as currently. And also if you think about the amount of debt level that we have, even if it has come down over the years, our cost of living, it is still carrying on. It is still going up, and that is impacting all of us, even those people who don't have any sort of debt or loans. And so a high level of inflation is actually a really big risk, especially if our wages don't keep up. And they're not really keeping up. Real wages have recently turned negative for both the UK and the US. In the UK, the Office for Budget Responsibility estimated that even with the so-called government support, the UK household will face 2.2% drop in real household income over the next 12 months. This is the biggest fall in living standard in any single financial year since the records have begun since 1956. So if high inflation has been a major concern for you or the person next to you, you guys are not the only one. Surveys from both the UK and the US show that it's been one of the top concerns for all of us for some time now. And if everyone starts to feel the same way, which is what is happening right now, we have a major problem. These drops in sentiments can drive 60 to 70% of a country's economic activity. That's how important consumers really are to an economy. If we think our financial situation will worsen and we stop buying stuff, that's pretty much recession, right? Now let's roll back to the stock market. At the beginning of the video, I mentioned how the stock market generally crashes before the economy does, right? And that's because even if the economy is actually in a much better position, as mentioned for various reasons, to rising interest rate is actually a completely different picture for the stock market right now. The overall stock market, especially the growth stocks, they're extremely vulnerable. And that's because even after all the weaknesses and the volatility, they are still relatively expensive by traditional measure of valuations. Look at the PE ratio. It is still very high, and high means expensive. So even a little bit of hike in interest rates will leave the stock market vulnerable. Although people could argue that most of this information about the rate hike is already priced in the stock market. But what I will say to that is that the other side of the rising interest rate risk is the actual level of profitability of these companies. I have mentioned how they have already reached the peak in terms of profitability because they have done so well over the past couple of months. And so it is only natural that the level of earnings growth will come down. So think about the real life scenario. Say while the growth level of earnings for companies are coming down, and when it is an earnings season, say that the analysts expect the company X to report an EPS number of say £2. But when the numbers actually come out, the EPS growth comes down and they actually report a number below £2. So that is below the analyst expectation, providing a downside surprise. And when that happens, what we typically see is that the stock price crashes down. So right now we do have a lot more probability of downside risk in the stock market over the coming months. Now let's end with what to do, how to navigate this volatile time. I don't give any investment advice, so none of these are any sort of advice directly to you. All I can say is what I have been doing during this time. Firstly, I have stopped investing in single stock company, exactly for the reason I have just given. So in my opinion, the amount of risk that I am taking or I can take by investing in single stock company is not well compensated with the level of reward or upside that I can expect to get back. And secondly, I have not stopped investing in my ISA account. In the UK, as you know, we get £20,000 allowance to invest tax-free in an ISA. So what I'm doing now, I am directing my investment or the money that I want to save or invest every month into my ISA account. However, rather than automatically investing them in a certain fund or an ETF, I am holding most of them as cash. And that's because I expect a lot more volatility to come about over the next couple of months, and so I do want to invest during the weakness. And finally, I have not sold out of any investment out of fear. In my past videos, I have shown that it is impossible to accurately time the market. And even if you tried to time it, it's much better to hold your investment because they can grow over time rather than coming in and out of it over time. So completely selling out of my investment is not something that I will do in the near future. I do have a long-term investment horizon, so my case is likely to be different to someone who's near a retirement age, for example. Having said that, one thing I have invested in over the last couple of months is in commodity ETF. So together, my investment in commodities ETF and the financial ETF have done relatively well compared to my other tech-related ETF. So if you are someone who likes to spend time and do a lot of research for the market and find pockets of opportunity, you could look to invest or you could look to research on the real asset side of the investment market. So things like funds or ETF that would track the property market, for example, or commodities such as gold or the energy market. So these are something that you can play around with. Again, these are not an investment advice. Always do your own research before investing. So as for me, I will continue to cautiously invest in the market, stay invested. That's basically my strategy. How about you? Let me know in the comment section below if you like. And until next time, do look after yourself and your money.